So without further delay, let me delve quickly into the topic for discussion today. And I'll start off with, asking a question to Mahesh. And Mahesh, so we are talking about transport and logistics being the key driver for our economy in the next decade and more. What are your thoughts on that? How would this play a role?
Sure, thanks Meda. And so if you look at the transportation sector and logistics sector, so transportation would be the auto sector, right? The two-wheelers, the four-wheelers, the tractor, commercial vehicles, and overall transportation will also include your airlines, shipping. So it's a pretty large sector in that wide sector, and if you look at in India, right, the way we are poised, right, our economy where it is per capita GDP at $2,300, you will see a larger spend on discretionary consumption. Okay, it will go up as a per capita income goes up, and the auto sector still, in spite of the fact that it has done well in the last decade, still the penetration levels are low. For example, in the four-wheelers, right, it's around 3%, and we see a good long runway of growth for this sector, driven by premiumization, affordability, right, and also we've seen that the whole content per car, okay, is going up, and also the EV transition which is there, which will also throw up opportunity for players to really capture that spend. Apart from that, I think in the auto ancillary sector is again a sector where it is not only domestic, but there are a lot of export opportunity which is there, and the way the globe is looking at now to move away from China, and a lot of European companies facing a lot of cost pressures, we see a auto ancillary sector can be again a key driver, okay, for the economy. And the logistics sector is something which is still an emerging sector, I would say, and if India has to be a manufacturing hub, then we need to bring down our logistics cost, which is around 14% or around 8% or so, and the government is giving a lot of incentive sector to really go in that direction. So this sector will see a lot of investments going forward, and as an economy, I think if we it is kind of a backbone, right? So if you look at the dedicated freight corridor which has just got completed, I mean that has brought down the whole time from say Dadri to Mundra by almost 1/3. So that has improved the productivity and the turnaround time. So I think the sector with the logistics adding to it, which is more of a service kind of a sector, it gives us a good play for investors to really look at it going forward.
Sure. Thanks for your insights, Mahesh. So Harish, this theme of course has multiple levers of growth. There are multiple growth drivers and there are various demand supply dynamics at play. So what do you think are the key levers out here?
Sure. So thank you, Meda. So clearly, one of the ways in which we can actually visualize the entire construct of mobility, because transportation logistics is all about us wanting to express ourselves in terms of mobility, right? So when we think of mobility, I guess a way to think about it is if you look at newspaper and a movie, right? If you look at newspaper headlines over the course of the last whatever 10, 15, 20, 30 years, they would invariably be speaking about wars, you would have elections, you would have specific events around there, right? Farmer suicides, a lot of negative barrage that comes through there. But when we look at it as a movie, you can actually see the progress. And I think to my mind, mobility sector is where we can see the maximum impact, visual impact right in our day-to-day lives. Be it the traffic that we all suffer through, clearly the number of vehicles that are going on the road, and more importantly, especially in the last 5-7 years, we've seen a massive increase in investment in highways, railways, all of these which are the key levers for growth beyond, right. So there has been a massive productivity reset that has happened over the course of the last 10-15 years, especially in sectors of mobility. And while there are always cycles in each sector, there was a phase over the last say 6-7 years where the auto sector as a whole was a bit sluggish in terms of demand for various reasons. But the underlying factor of productivity growth has been supremely strong, which is where now we think that as the cycle starts improving, they can benefit both from that productivity lever as well as the inherent supply demand mismatch, be it in terms of say passenger car vehicles out there, commercial vehicle tonnage that is likely to go up, dedicated freight corridor, a massive investment that has happened both on the western line and on the eastern line, which can open up a significant amount of transportation that's going from the roads to the railways. You can have newer ways of transportation, including say on rivers and the waterways starting to come through. And of course the discretionary consumption, especially in a post-COVID world where we all want to go and see experiences a lot more, which clearly are. So I think if I look at it, the demand drivers for each of them seem reasonably very strong. Yes, they are at the back of the mind, still linked to discretionary spending. They are not essential, so therefore a feel good is definitely needed. But by and large, I think the demand drivers are stacked up very well in almost all of these. From a supply side, clearly the government's ambitious infrastructure program, which has been rolled out and has been executed quite well over the course of the last 5, 10, 15 years, sets the stage for a very good explosive growth from both supply and demand in each of these subsectors.
Sure. So as a follow-up, Harish, and like you rightly pointed out, though the theme is diverse and quite structural in its construct, but at the same time having the element of discretionary piece being there, there is also a related element of cyclicality associated to the theme. So how would you segregate both the elements, and how much allocation, probably if you can, would you give to the structural bit and the cyclicality in this theme?
So I think it's a great question, Medha, because at the end of the day every sector goes through and is exposed through cyclicality. And yes, many of these sectors within the broader theme are definitely a lot more cyclical than some others. But when we look at it in the construct of each and every sector which is out there, at this point of time, from a cyclical perspective also we are well poised. The structural parameters are all, the fact that penetration is low in almost every category clearly comes through very strongly, right? If you look at, say for example, the four-wheeler, the average age of the vehicles which are there, the stock of vehicles is now at a multi-decadal high, which means that just the replacement demand of that is itself going to come through. And even within these cyclical kind of constructs, you have the more structural trends of, say, premiumization, as Mahesh rightly pointed out. We clearly seeing more and more cars getting more and more premium. For example, 1 in 4 cars in India is having a sunroof, right? In a space, in a weather like India, which ideally does not really require the benefits of a sunroof, yet that's more a status and more an aspirational element. So I think there is clearly a cyclical aspect to it, but there are structural trends within that. EV and the rising EV is one trend. The fact that greater, higher tonnage trucks are getting sold, that could be another trend. The shift back into rail, which is a far more efficient way of transportation, that could be another trend. The fact that we are seeing so many airports being opened up itself would mean that aviation can be on the trend. So I think there is definitely a cyclicality, but I think the current phase of time, I would be a lot more comforted thinking that this is also a bit more structural at this point of time than necessarily being lumped into a cyclical sector.
Sure. So Dhaval, moving on to you, and since automobiles is, I think, at the heart of this theme, and auto stocks have played out quite well over the past few quarters. So how do you see, the sector's performance or growth coming around in the next 3 to 5 years?
Thank you, Medha. I think the broad story of the construct being more structural at current time remains fairly there. If I have to look at, say, purely automobiles as a space, there are sub-segments within the automobiles, whether it is a passenger car or a two-wheeler or a commercial vehicle or a tractors market, and most of these sub-sectors have their peak demand or trough demand in a different cycle, means not all go up together or all come down together. Today if you ask me per se, I would be most bullish on passenger vehicle and two-wheeler market. Maybe just to give you a story, last few years if you look at we had all possible negatives for this sector, right from 2014-15 times to 2020-21, and I think the next decade is for automobile sector. So we had demonetization, we had GST, we had BS4 to BS6 transmission, which was more regulatory, which led to very sharp rise in prices for all type of vehicles. Then we had general slowdown, we had higher input costs, we also had COVID taking out 2 years. So you've seen material number of years where volumes got disrupted. So that supply side is getting back, first thing, and the rising income trends in the country with our median age at 28 years, somewhere what China was 20 years back, and our car penetration numbers also for every 1,000 people is somewhere what China was 20 years back. So all these do point towards that we could have a next 10-15 years of runway of growth. Another important thing is, say, in electric vehicles, it's been in the news flow for last 10 years. No other country than China actually has seen an adoption of electric vehicles being very high. But if you look at from a stock market's point of view, stock prices have already been reacting or has seen a sentimental negative because of opportunity of electric vehicles. So I believe that is now going to be more complementing the overall volume growth rather than impacting the ICE manufacturing automobile companies.
Sure. So the other important piece, Dhaval, in this theme is auto ancillary and OEM as a part of the investment universe. And so in the current market scenario, and here let me allude to how the mid cap and the small cap segments have played out, and how the large cap, whatever your views are. So how do you look at the overall portfolio construct, and what is your outlook on the auto ancillary segment?
So as I was talking about, say, in auto sector, last 10 years we've seen turbulent times in several years, but auto ancillary as a sector has been more secular. So Harish was mentioning about the structural and cyclical construct of the sector. How we look at it is, automobiles could be more cyclical because there is sub segments which may grow at some year, some may not, but auto ancillary is more of a structural story. So key 3 drivers for us in our view is, one is a super product diversification which is at play with few auto ancillary companies. Second, we look at these companies can actually deliver to both ICE manufacturing OEMs as well as EV manufacturing OEMs. They've been able to produce or have new products which can cater to EV companies. The third, the export demand. India is invariably becoming an export hub or an auto hub because of China plus one and Europe plus one strategies. So all in all, if you look at these 3 key drivers, I believe auto ancillary sector could continue to be more of a secular growth story versus overall auto consumption also in the country. So in that sense, auto ancillary is more of a sunrise sector within the entire transportation and logistics piece.
Sure. So Dhaval, logistics indeed sounds very interesting, and I think no one can deny about the structural opportunity that lies in the logistics space. But as we speak currently, it's still a big capex story. So what are your views in terms of making investments there, and the performance that this segment can generate?
So as Mahesh mentioned, it's more of an emerging sector. It's not very clearly understood is what we believe what is logistics sector. So in our thoughts, what we tried breaking this sector into sub parts. So multiple sectors lies within logistics sector. We look at, there are 3 types of way to look at logistics sector, that is B2B, business to business, then there is global trade, which is a cross-border global freight services business, and then there is B2C, which could be the segment which could grow very fast. So India is still fairly inefficient when it comes to delivering logistics sector. Now whether if you want to become a manufacturing hub or in general have a very strong trade services within the country, we would need an efficient logistics sector. Couple of years back, our Prime Minister announced a Gati Shakti Yojana purely to bring in more efficiency to logistics sector. Today the 7 engines of logistics, which is roadways, ports, airports, waterways, modal transit or logistic infra, they work under 68 different ministries. They work under their own silos. So to bring in a cohesive approach, bring in a better outlook. Today, just to give you an example, a project report which used to take more than 12 months to 18 months to get finalized, I'm just talking about the project report and not actual project outlay, is now happening in 15 days to 30 days time, which itself is changing timelines when it respect to delivering logistics, basically creating supply side resolving the supply side things from the logistics sector. So then if I have to talk about, there are new ports which are coming in, privatization of ports is happening, the dedicated freight corridor would reduce the travel time, transit time. Then you look at B2C logistics, which in our view could become fairly big. Just to give you an anecdotal example, it coming out of one of the DRHP of the company which got listed couple of years back. In 2021 in India, we did close to 270 crore parcels as a country, which is roughly 2 crore parcels if you assume 135 crore population annually. Same was the number for China in 2010. In 2021, China did 8,300 crores of parcels in that year. For both the countries, it was COVID impacted year, and I'm sure the activity level has only gone up to now. So China saw 40% CAGR growth between 2009 to 2021 in terms of B2C logistics growth. Can we replicate that? Or can we even grow at 20-25%? I think that offers a very great opportunity for e-commerce or courier companies in that sense, which could be the participants in B2C logistics.
Sure. Thanks for that, Dhaval. And I would like to ask you one question from the side of our viewers, and most of our viewers would want to know this. So what are your thoughts behind the time that we are looking at launching the fund and inviting investors to participate in this theme, and what would be the expected growth rate according to you, if at all you can put a number around it, over the next 3 to 5 years in this fund?
So generally, see, it's definitely a thematic fund, so people do understand, but we do believe purely from a penetration point of view and consumption, discretionary consumption trend point of view and income rise, this could be a reasonable 5 years plus product which investors should look at. Investors should come with at least a 3 years type of minimum investment horizon. I think that this sector has a very smallish representation within the broader indices like Nifty 50 or Nifty 500 index. I believe that only number goes up in times to come. So one could expect returns which could be higher than markets. The last 15 to 18 years of time frame, if one has to look at, the benchmark for this fund has delivered 300 basis points CAGR returns higher than Nifty 50 or Nifty 500. Should one expect similar in the times to come? I believe the trends of the sector or the fundamentals of the sector do point answer towards a yes.
Sure. So Mahesh, coming back to you, and when we are doing this fund and as a part of a thematic portfolio, of course it's a structural theme and commands a space, but what are a couple of other themes that you would recommend from a fund house's standpoint, which investors should consider as a part of their thematic portfolio over the next, say, 5 years?
Yeah, so I think we recommend thematics normally to be say around 15-20% of a client's portfolio and to play those themes. So a couple of themes which we think will do well, right, over the next say 3 to 5 years. One is banking and financials, because again this is a sector over a market cycle, if you done again that just like the transport and logistics has done well, and we are coming through a period, right, where the Indian economy is likely to take off. Okay, we are seeing good growth going forward, a more sustainable growth going forward. Even the credit growth has actually surprised us on the positive, right, and overall I think the banking sector is now fairly well capitalized. The capex cycle recovery in the economy, I think we have seen a big kind of a contraction in the investment to GDP. We think that's going to change, so that will drive overall credit growth, and overall the corporate balance sheets are in fairly good shape. We have seen a large amount of deleveraging, so that would mean that the NPA, the credit cycle, should be fairly good. So, and again the sector has not done as well, banks, especially the larger banks, right, so the valuations are also reasonable, so that can be a good theme to look at. It's a more broader play on the economy, right. Apart from that, I think more a structural theme, if you ask me, I think which we are really bullish upon is the whole consumer discretionary theme, right, in India, because India is at an inflection point where demand, discretionary consumption as a percent of total consumption, which is roughly around 25% or so, is likely to go to around 40%, okay, in the next 10 years. And that will drive demand for all consumer durables, apparel, retail, footwear, QSR, travel, tourism. So that is a sector which is really banking on the whole demographic dividend of India, the young population, which is also aspirational, as I said earlier. And that's a sector which will have a long, I mean, it's not a decadal theme or even a 2-decade theme. And I think we hasn't done too well in the last 1 year, because discretionary consumption has seen some kind of an impact coming out of COVID, and rural economy has been weak. But I think the key elements are in place for this sector to do well. So a fund like Gen Next Fund is a fund which is ideally placed to really capture that. So I think these two, one is the most cyclical and one is the most structural themes, okay, which one can add to the client's portfolio.
Sure. Thanks for that, Mahesh. And before we conclude the session, and when we have both you and Harish on the same panel, how can we let you all go without you sharing your views on the market? So maybe a quick, few insights from you on how do you see the market holding up, and especially in light of, general elections being lined up next year. And Harish, the same question, I would seek a response from you as well after Mahesh's response.
Yeah, so the markets, the short term, we are seeing some volatility again, some global risk off, because interest rates, we all know in the US, okay, they have kind of remained, I mean, they've gone to around 5% or so, and likely to remain higher. So I think you will see short term volatility, but I think the structural drivers, as we mentioned, right, are in place for India. I think GDP will continue to grow at around, say, 6.5%, and more sustainable, because all the reforms what we have done in the last 7-8 years, I think it's the time to benefit that. And geopolitically also, where India is placed, right, we are in a very favorable situation where you will see manufacturing, right, also India becoming a next manufacturing hub after China. And I think given that, I think you will see the overall earnings growth, right, for India is looking fairly stable. I mean, we have seen last 3 years of very strong growth. We think even going forward, you should see around mid-teens growth. And the good thing is that it's more broad based, right? There are many sectors. It's not like a few sectors which are doing well, which was like during the pre-COVID period. So there are a lot of sectors which are doing, whether it's automobile, the banking sector, the capital goods sector, right, the real estate sector after a long period of downturn. So I think, and the market is fairly priced now, right? After the underperformance, what we have seen last 2 years, the market is nifty, especially the large cap space hasn't really gone anywhere. So I think you will get compounding from here earnings. I think that's what I think investors should expect from the market going forward. And this is the market we bought into dips, right? It will scale at new highs is what we think. And despite the uncertainty, elections, I think those, I think, will only be opportunities, because we have seen that despite any government, if the economic momentum is good, market has its own momentum to really carry it forward from there.
Sure. Harish, your views?
Kind of echo the same sentiment, Medha. So while clearly near term calling out markets is anybody's guess, because markets have a way to surprise anyone and everyone in the near term. I think the better approach, in my opinion, is also to look at how the markets and the economy structure is likely to move over the course of the next 3-5 years. Again, coming to the same reference of looking at it as a movie, right? So, and when we are looking at it as a movie, as they say in sport, you have to be not the where the ball is today, but where the ball is likely to go over the course of time, and that is what we would advise viewers to look at. So, if you look at from an India perspective, and let's say that India's share of the world GDP as it stands today is close to about 3.4%. Indian equities, which has done quite well, we all know that Sensex and Nifty have done exceedingly well. Equity mutual funds have created significant wealth for investors. At this point of time, the total market capitalization of India as a percentage of the world market capitalization is also at 3.4%. So while near term it does appear fully priced, etc., if you were to take a call that over the course of the next 5-7 years, India's share of GDP is likely to go from say 3.3, 3.4 to maybe say 4.5, 5, 6, 7%. Just to again, as Dhaval has rightly pointed out, the similarities to China. China was 3.3% of the world GDP in 2000. Today they are at about 18% of the world GDP. Now, I don't know whether we will go from 3.3 to 18, but is there a journey to be visualized from 3.3 going to say 5, 6, 7, 8, 9, and therefore can the market cap also start aligning over a period of time, and that really is the opportunity that we see. So I think rather than worrying about elections, market levels, etc., it will be a lot better for viewers to look at where the ball will likely to go, say under 5, 7, 10 years from now. And clearly I think from that count we are extremely positive and convinced about Indian equities finding its way into household savings of India and creating and compounding wealth for Indian savers.
Sure. Well said, Harish. I do have a couple of questions also for the panel from the audience. So the first one goes as, where do we see metal industries vis-a-vis government norms which keep changing for mining? So where do we see the outlook for metal industries in the backdrop of government norms or policies which keep changing for mining? That's the question that's there. Maybe any one of you all
Sure,
can.
maybe I'll just add a response to this. At least as far as equity prices of metals are concerned, it's more a function of what the big daddy, which is China, is doing, because that accounts for anywhere between 40 to 60% of the, or maybe even more in certain cases, of the world demand. Right, and clearly China seems to be having some kind of a bother in the near term. They try to stimulate their economy, but there's significant issues, as we understand, sitting out of India in their real estate and property sector. So therefore, if the biggest driver of growth is a bit challenged, it doesn't really paint a very great picture in terms of the demand or the pull in terms of the demand of these metals, and therefore it is more a function of supply. And so as the viewer has rightly asked, how is the Indian policy for extraction of various metals and minerals therefore going to be shaped? I think across the world countries and citizens are getting a bit more environmentally focused, so therefore that is definitely going to be a premium to mine metal in a more environmental friendly way. So in that sense there is going to be some kind of a cost push that is going to increase for metals. Will they be able to pass it on in an environment where the Chinese demand is sluggish? Remains to be seen. So I would say we would be slightly more selective on the overall metal pack as a whole, even though in India it's hard to really find a structural negative sector. But from a slightly near term, I would say that we would be a slightly more underweight on the space.
Sure. The next question that so what are the key risks that you cite at this point in time with in relation to markets, or how global scenario is emerging up, global macro scenario? What are the key risks that you identify?
So you want?
Yeah, I guess. I think the risk at the moment, it looks like apparently from the global side, because that's where the sharpest increase in interest rate what we have seen. I think again that's where the unwind of liquidity will happen, and that's where we will see when such a sharp increase in interest rate happen and remains likely for a longer period of time. You could see something, we saw some scare sometime back in the US regional banks, right, which played out. So I think the key source of risk will come in from the developed markets is what I think. But again, on the domestic side, again, I mean, I don't see a risk, but volatility because of elections, I think market tends to look into that. But I think India's overall story is fairly intact, right? Unless we do something really foolish, I think a lot of things have got mitigated, at least from a domestic standpoint. Whether it's on the external front, I think we are in a fairly good situation at this point in time. So I would say that domestic, less of domestic, more of global. I think oil, again, the geopolitical risks, again, we saw that play out last year, right? Again, it's still Russia-Ukraine war is still there. We have the Israel conflict which is there. So if that leads to spread out in that region and oil prices go up, again, that could lead to some volatility. But that too also, I think we have seen that oil go up to around $110, but still we are able to manage that because exports, right? Okay, or on the trade side, okay, we have done fairly well, especially services exports. Sure. So I think these are some of the risks which I think which in any these are all risks which are there at any point in time, right? I think so.
Sure. If I may add, I guess the other risk is possibly investor expectations. Right? It's always good to moderate expectations, especially when everything else, as Mahesh rightly said. I think we are on the right side of so many things, but we shouldn't just get carried away in terms of believing that it's a birthright to constantly every year make say strong double digit returns, etc. So moderate expectations typically leads to a better outcome. So therefore, and which is what Dhaval also rightly pointed out, that we are looking at investors to view this fund as well as our other equity offerings with a longer term horizon, because time is possibly the best solution rather than wanting quick rich schemes out there. I think one will have to moderate expectations, and then I think a lot of these risks can then be obviated.
Sure. Very well put, Harish. And before I conclude, Dhaval, actually a few questions on our topic. Is this fund ideal for SIP or lump sum? Horizon, I think you've already covered. What should be the ideal investment horizon? And what should be the amount of investment? Maybe that means that, you know, what percentage of the portfolio should be considered to be allocated in this fund?
So for different investors or various investors are a different investing cycle with respect to their wealth creation or their savings. As Mahesh also pointed out, maybe most of the thematic fund should be 15 to 20% of your portfolio, say with an high risk or a lower age investor, which is early 20s, early 30s, then can have higher allocations to thematic funds. And we would look at 2 to 3 thematic funds for that 20-25% of weightage. So you get an answer that how much you should invest in this fund. Second, as I mentioned, this theme looks like for the next decade at least from our side. So I would suggest you should come in SIP for 3 to 5 years point of view. Lump sum investments, if are always for more than 3 years, should not be a worry that any difficult year because of the markets or any external things, your CAGR return should always be higher than markets is what our endeavor should be. So you should look at 3 years plus investment. You should come with an SIP. Lump sums are always welcome. And I think from a allocation point of view, 15 to 20% in thematic funds.
Sure. Thanks for that, Dhaval. Now, in view of the paucity of time that we have, we will have to conclude the session. So thank you very much to all our panelists for sharing your views. Thank you to all our viewers for tuning into this session today. And with that, we'll conclude the session. Please have a nice day ahead. Thank you.